You all for joining our Understanding Market Volatility and Uncertainty webinar. Very timely. I am Jessica Ballin, and I'm one of the advisors on the 401k Plan Professionals team, and very excited to have Marta Rodriguez join us today. Marta is a client advisor for the Defined Contribution Investment Only team at JP Morgan. But more importantly, Marta is a very valuable resource to our team. And you might recognize Marta as she does co-host our annual market update webinar that we host every January. They have a lot of resources that help us serve our clients, including their daily updated now guide to the market. So we're really excited to have Marta give us some insight today. Today's webinar is being recorded, and I know I have the Q&A up, so I will be monitoring that. So feel free to ask your questions inside of that. I know as some of you registered today, or registered for the event today, you did put some questions while you registered. So we'll try to have some time at the end to address kind of some of the top questions you all likely have. So before I turn it over to Marta, I just want to say that on behalf of our team, we do recognize that this is a very scary time. There is a lot of uncertainty, a lot of unknowns. And as an investor, this can be a really scary time for you. And so we hope that today we can provide some insight and maybe a little peace of mind as well to you all. So with that, Marta, I will let you kick it off and give us some of yours and JP Morgan's insight on our current situation.
Great. Thank you so much, Jessica. So to start things off, I want to share with you that I am not the biggest fan of roller coasters. But being a mom to two teenage boys who love roller coasters, I have slowly become more brave and I've come to actually enjoy the thrill of the moderate roller coaster. This past week in the markets has not been a moderate roller coaster, but an extreme thrill roller coaster with steep falls and rises. And the bad thing is that we don't even know when the ride is over. However, I have resolved not to look at my 401k plan statement until the end of the year in order to not cause anxiety and to more importantly, take a step back and remind myself that my investment horizon is a long one, at least 20 years before I'm even going to touch that money. So this perspective provides a bit of comfort and makes the roller coaster ride of the markets more bearable. And that is my goal today, to help you all take a step back, reassess where we are on the economic front on a range of different factors, see how that affects the investment landscape, and finish up with a few slides around the investment basics when it comes to long-term investing to help us all stay on this roller coaster ride until it is time for us to get off. So with that, let's get started. And I'll be using slides from our latest guide to the markets, which was published as of the end of March 31st. As some of this data is already outdated, as a lot has happened in the past week. But starting with the growth of the economy, when we look at gross domestic product, coming into this year, the US economy looks strong, although momentum appears to have faded during this first quarter. To understand why economic activity has been so resilient, why it has slowed down somewhat, and also where it is going, it's best to look under the hood at the different components that make up GDP. And this slide here offers that insights that we're looking for. Starting with the blue line is consumption. Given that consumption accounts for almost 70% of the US economy, it's no surprise that the health of the economy is closely tied to us, the consumer, and what we buy. Supported by impressive gains in household wealth and also 22 months of positive real wage growth, consumer spending has powered the economy forward, rising 2.7% during the fourth quarter of last year. Going to gray, the business fixed investment, that has slowed down a bit after a string of strong prints, likely due reflecting the lagged impact of higher rates earlier in 2024. But you also see that residential fixed income improved after 2 straight quarters of declines. The decline in mortgage rates, so in the orange, where it says residential, as well as suppressed level of overall housing starts, so building of houses, suggests that there is some room for revival in the housing market. But with a sudden plunge in immigration, it could impede not only housing demand, but also building activity, so building of the houses moving forward. Government spending in green has helped boost growth in recent quarters. That said, budget cutbacks could limit any more meaningful support from the federal or state and local government in the months ahead. Really, it's the policy uncertainty that's casting an overall fog on the economic outlook right now. Recent data has shown a huge spike previously in imports, driven probably by businesses that were looking to front run some of the tariffs that were announced. Should imports remain elevated, it's possible that we get a negative print on gross domestic product here because of the purple, the net exports would be negative. On top of that, weaker vehicle and retail sales through February point to a slowdown in consumer spending from its booming fourth quarter pace. So again, it's pair that with just overall consumer confidence and business sentiment, going lower. It's clear that the economy has slipped a gear. That said, it's unclear whether that slowdown is a start of a moderation back to trend growth of 2% growth or the beginning of something a little bit more serious. So that's growth. Taking a look at unemployment and wages. If you look at the gray line, which is the unemployment rate, it stabilized here close to 4% for the better part of last year. At 4.1% in February, that's meaningfully above its cycle low of 3.4% that was set in April of 2023. But it still is a lot lower than it has been almost 90% of the time over the past 50 years. Importantly, we see this last year's rise in the unemployment rate as more of a normalization of an economy operating at above full employment. So presently, this looks pretty good. As the year progresses, job growth could slow a little bit alongside economic activity, but should remain positive. Layoffs have remained low, but any meaningful increase could pressure unemployment higher, although slower labor force growth due to more restrictive immigration policies may offset some of that. Turning to the blue line, that's the wage growth. After peaking at 7% in March of 2022, wage growth has slowed back to trend, with wages for private production and non-supervisory workers clocking in around 4.1% year over year as of February, just above that 50-year average. Again, while slower immigration could put upward pressure on wages, sustained strong overall productivity gains should help limit any of that pass-through to inflation. So again, when thinking overall of unemployment and wages, pretty good as well, not too bad. Shifting to the companies and businesses and their sources of earnings growth and profit margins. S&P 500 earnings grew 10% in 2024. You can see that on the left-hand side of this chart in the fourth column to the right there. It capped off, it was by a really impressive fourth quarter 24 earnings season that saw earnings rise roughly 18% year over year. Margins were the key driver of contribution here, which contributed over 13 percentage points to overall growth. Beneath the surface, earnings continued to broaden out. If you recall, a lot of the performance in the S&P 500 over the last couple of years was really driven by the success of those magnificent 7 stocks that really drove performance. However, starting last year, you did start to see a broadening out of positive earnings amongst the remaining 490 stocks in the S&P 500, as well as earnings were positive amongst 10 of the 11 S&P 500 sectors last year. And we anticipate that this continuation of the broadening out of the earnings growth will continue in 2025 as well. Analysts are projecting an even stronger growth of 11% in 2025. and 14% in 2026. However, earnings are cyclical, and compared to the long-term average of 7.3%, we think those estimates are a little bit rosy, particularly given our expectation for a slightly slowing down of nominal growth. So, and I think also companies that fail to meet expectations in this environment may be punished more than usual. In times like these, though, investors can use active management to help play defense in portfolios. And this involves limiting exposure to companies that may be burdened by elevated valuations and expectations, and focusing on some of those companies that have really been underappreciated and that are less susceptible to market sell-offs. So switching gears and going to inflation. We have a very colorful chart here. And the inflation, up until just a couple years ago, this chart looked pretty boring as it was pretty flat. But really starting in 21 and 22, the numbers start spiking all over the place and are starting to go down. Headline CPI, Consumer Price Index, came in better than expected in February, rising 2.8% year over year compared to 3% in January. That said, it remains well above last September's print of 2.4%. We still believe that underlying price pressures are easing, but come spring, like right now, the effects of tariffs could push inflation higher. If you take a look at orange, the core good prices, they were a steady source of deflation throughout 2024. In recent months, however, prices have moved higher. New and used vehicles are largely to blame for that, with prices likely being pressured by increased replacement demand as people have had to go out and buy cars following recent hurricanes and wildfires that have affected our country. On the more volatile components, energy and food inflation have been running hotter recently, although both eased in February. With tariffs now having been imposed across a number of different countries, all these categories could see price rise meaningfully in the months ahead. Elsewhere, you'll see in dark blue, shelter, as well as auto insurance in red. Those two things remain key contributors to inflation. Shelter accounts for almost a third of the CPI basket, and while showing signs of easing recently, they still have remained a little bit stubbornly high versus pre-pandemic trend. Also, auto insurance has backed off, but still rose 11.8% year over year in February. Fortunately, as last year's rollover in vehicle prices feed through the data, we should see that start to trend down as well. So while progress on disinflation has been encouraging, the last leg down to the Fed's aim of getting to 2% could prove more difficult to achieve due to tariffs. In fact, based on what we know about tariffs so far, inflation at or above 3% by the end of this year is not out of the question. Speaking of tariffs, we have a whole chart dedicated to tariffs. And I was mentioning earlier to Jessica, that this was printed as of March 31st, but it's already out of date as these numbers have dramatically changed over the last week. And just yesterday, maybe some of you have saw that the stock market surged up on the news that President Trump is implementing a 90-day pause on reciprocal tariffs on most countries outside of China that had caused the stock market to plunge just the week prior. So what has happened, and what is the latest with tariffs? Just as a reminder, over time, economic globalization has led to increasingly relaxed trade policies over the years. And indeed, the average tariff on U.S. goods imports has steadily fallen since the 1930s, as you can see on this chart. However, geopolitical tensions and supply chain snarls induced by COVID-19 have prompted a reevaluation of open trade policies. Also, with promises to protect American businesses and address unfair trade practices, tariffs sit at the center of the Trump administration's policy agenda. So what has happened with tariffs, right? So last week, on April 2nd, President issued an executive order based on a national emergency with two main tariff announcements: a 10% universal tariff on U.S. imports with the goal of raising revenue, and that went into effect April 5th, as well as higher tariffs on 25 plus of the country's biggest trading partners based on their trade deficit with the US. And that went into effect April 9th. And that's what we just saw the pause on yesterday. So what does this all, and so on this chart, you'll see in the far right here, as of March 31st, we were estimating that the average tariff would be closer to 8%. However, because of the recent announcements, the average effective tariff rate would have been 25%, but now with the pause in the reciprocal tariffs, that would still hover around 15%. But that is still the highest rate since the 1930s. And so I don't think the issues around growth, how it affects growth and inflation, is just simply going to go away. So, what are the economic and market impacts? In the short term, economic impacts of tariffs tend to be stagflationary, where one-time increase in tariffs may hit U.S. businesses' bottom line, and some of that may be passed on to the end consumer through raising prices. But and also more importantly, businesses' decisions in regards to investments and regards to hiring people, what projects they want to take on. A lot of that right now, businesses are taking a wait and see approach. They're postponing or even canceling this, not sure what the policy will be going forward, which puts a pause on everything. And consumers may also start to pull back on some bigger purchases that we might have been wanting to do prior. Previously as well, recession risk has increased due to policy uncertainty and may increase further depending on the duration of these. So more to come on this. Things to maybe consider is obviously a balanced portfolio, right, with adequate exposure to bonds, as well as diversified equity exposure. I'll talk a little bit later on how well international has done so far this year, but also beyond mega cap tech names, broadening out and diversifying amongst lower small and mid cap as well, and other companies with and staying away from those with lofty valuations and lower qualities that may be more vulnerable to these market shocks. So moving on to labor supply. The labor market has normalized from its post-pandemic boom, but job growth has settled into a relatively healthy pace. That said, the Trump administration has expressed its intent to meaningfully reduce immigration, which could have some impacts on the labor market in this year and beyond. After falling sharply during the pandemic, labor supply in the US staged quite an impressive recovery, largely due to the increased immigration. If you take a look at the upper right chart of this slide, you'll see that of the roughly 10.6 million individuals that joined the labor force between January of 2021 to January of 2025, 54% of them were born outside the US. With this surge in foreign-born workers, employers were able to actually fill open job openings without applying upward pressure to wages, which really helps explain why strong job creation hasn't sparked higher inflation up until now. But we'll see how that shakes out for the rest of this year. But it's also worth noting that a strong recovery in the labor force participation rate has boosted labor supply. And on the bottom right, on the labor force participation chart, while we've seen the continuing aging of baby boomers exiting working into their retirement years, and that has left the overall labor force participation rate below pre-pandemic levels, participation among the prime age workers, so those aged 18 to 64, that blue line, has fully recovered its pandemic losses. So again, that's a good thing. So moving forward, employment growth is likely to slow throughout 2025, but solid corporate profits should keep it from collapsing. I want to touch briefly on federal finances as another one of the Trump administration has expressed its intent to fully extend the Tax Cuts and Jobs Act, or the TCJA, and reduce the corporate tax rate. It also promised to dramatically cut costs. And so in determining whether those policies are feasible and how they could impact the overall fiscal health of this country, this slide is super helpful. The left chart shows the Congressional Budget Office's estimates for government spending and how that spending will be financed in fiscal year 2025. To reach its cost-cutting goals, the incoming administration may have to make some difficult decisions because non-defense discretionary spending in orange there accounts for just 14% of the overall budget, meaning that they're going to have to explore spending cuts on perhaps defense or entitlements, which would be very unpopular. Initial efforts by the newly formed Department of Government Efficiency has focused on federal workforce reductions to cut costs. While the extent of the federal layoffs still are largely unknown, their overall cost savings won't be that significant. And we do estimate that less than 6% of the budget went towards federal employee compensation in fiscal year 2024. The administration also expressed its intent to use tariff revenues to offset the extension of the Tax Cuts and Jobs Act. When you look on the right side there, it's a very little sliver there where it says tariffs are only a small part of the current government revenues, and that will likely remain the case. Moreover, higher tariffs may invite retaliatory tariffs, and which could slow the economy, reducing revenues from other areas. And this all does impact the overall deficit, which could continue to go up, and the debts here in the US, which could act as a longer-term source of inflationary pressure. So how should the Fed respond? Right now, they're uncertain as well. The Federal Reserve finds itself in an unenviable situation heading into the second quarter here. After delivering 100 basis points of rate cuts last year, the Fed was confronted by slowing economic activity and stalling disinflation progress in early 2025. But the committee does have a preference to continue easing policy until it reaches a neutral stance. However, fiscal stimulus, in addition to tariff and immigration policies, could make this difficult to achieve. So as expected, the Federal Reserve in their last meeting voted to maintain the Fed funds rates within the range of 4.25 to 4.5%. And that's that gray last dot there on the far right. And with tariffs top of mind, the summary of economic projections reflect expectations for slower growth and higher inflation in the near term. Their growth forecast was downgraded from 2.1% to 1.7%. And headline and core inflation forecasts increased by 20 basis points and 30 basis points respectively. So more to come on this. The markets, which are the green, the markets are pricing in just under 3 full rate cuts in 2025, but it really depends on the growth, what happens, and and how the government policy plays out and how it affects these different factors. So let's take a look at a number of different economic factors. I'm going to switch gears and do 3 slides on just from the investment side on fixed income, stocks, and global, how we should think about how it affects those specific asset classes. Taking a look at the credit market dynamics. After an impressive rally in 2024, fears of an economic slowdown forced investment grade and high yield credit spreads modestly wider during the first quarter of this year. But even still, both sectors are up so far positive, where stocks are down right now, so far this year. And spreads do continue to look tight relative to history. So this tells us that the corporate credit market is not overly concerned about a looming recession. We think investors should embrace credit for the attractive all-in yields that are still found there. Spreads could widen further as economic momentum fades. However, corporate credit is better prepared now than it ever has been to weather a slowdown due to the fact that the credit quality overall has improved dramatically since the Great Financial Crisis. You see that evidenced by the credit rating chart on the upper right, as well as the default rates in the lower right have dramatically decreased as well. So still a place to go for those who are looking to find a little bit higher yield and are wanting to not put everything into the stock market. Speaking of stocks, S&P valuation measures, again, despite strong earnings outlook, elevated uncertainty at elevated valuations is a significant risk for U.S. equities. The concentrated rally of the past 2 years, as I mentioned before, left room for plenty of correction, and we have seen some of that correction already so far this year. With the first quarter, the 10% drawdown from the February highs in the S&P 500 and even more so last week. But even with this sell-off, the next 12-month price to earnings ratio is still one standard deviation above its long-term average. So the Magnificent Seven are responsible for a large portion of this distortion and the recent downturn. But it is worth noting that these companies are still profitable, even though they are overvalued. And while many of them could certainly benefit from AI and technological change, can be unpredictable and disruptive, as evidenced by the DeepSeek situation from earlier this year. That paired with the new administration and some of the policy that could serve as a source of uncertainty. But again, AI and policy, they are driving U.S. equity markets, but the destination isn't quite clear. So as such, we encourage investors to ensure that their portfolio isn't overexposed to some of the most overvalued parts of the market, and instead consider formerly unloved parts of the market to reduce the impact that a broader downturn could have on portfolios. And going to global equity markets, I like this chart only because for once, the numbers look really good outside the US. For all over the years that we've been talking about staying diversified, and the US really has dominated from a performance perspective, but global equity market dynamics has shifted meaningfully during the first quarter, with international stocks surging ahead of US stocks by the widest margin seen since the 1990s. Weak expectations, though, for international markets did lead to depressed valuations, which did set the stage for that rebound. It reminds all of us that valuations still do matter. Also, as seen on the left side of the chart here, the dollar's recent decline has also boosted US dollar returns for a range of markets. So just as US equities were overvalued, so was the dollar. So although investors have benefited from overweighting the US in recent history, the tide can always change. And in times of increased uncertainty, investors can play defense by diversifying their equity exposure across a range of different global markets. I know we're running close on time here. There's just 3 more slides I want to touch on briefly. And these are some of my favorites in regards to just some investment basics. This chart here reflects the fact that market volatility can make investing feeling very challenging at times, and it can really take our emotions for a ride. However, while volatility might not feel good, it's important to remember that double-digit intra-year declines are typical, as evidenced by all these red dots you see on this chart. Historically, the intra-year decline has been around 14%. Yet annual returns were positive in 34 of the past 45 years. So again, if your time horizon is a long one, it pays to stay invested. And a key principle of successful investing is recognizing that it's not about timing the market, but rather time in the market. The other slide I like a lot is this consumer confidence and the stock market. This shows that the jump in how we feel as consumers over time. And then that box in the upper left-hand part of that slide shows that the subsequent 12-month returns after S&P 500 peaks and troughs. And it shows that when we're feeling really good about things in the markets, the following 12 months have historically returned on average 3.9%. But when things we felt really bad about what's been going on in the markets, those troughs, the following 12 months have on average returned 24.1%. Now, we're not saying that's what you're going to expect going forward, but it is helpful to realize that when we're feeling bad is when we shouldn't abandon our being in the markets and staying diversified for the long haul. And lastly, speaking of diversification, this chart shows historical returns by holding periods for stocks, bonds, and that 60-40 portfolio. And whereas you'll notice for the 1-year number here, the ranges can be quite wide. So positive and negative returns for the 1 year, you pan that out to 10 years and beyond, every single one of those will produce positive returns. So again, having a diversified portfolio, staying invested is the way to go for reaching our retirement goals. So with that, I'm going to turn over to Jessica to see if there are any questions or last comments.
Yes, thank you. And we might go a little bit beyond the 10:30, so if you have to hop off, that's totally fine as well. I think too, a couple of the biggest questions that we have received in the chat or just in general. One of them is do you or the JP Morgan team have an expectation on the length of this volatility? Like the volatility, the extreme volatility is really difficult for most investors. So
Sure.
do you have any pulse on the timing or not really?
It's really hard just because the current administration is not clear
Mhm.
on what they're doing, right? And what they're saying. I mean, they have a lot of ideas, but like as we saw just evidence last week, right? They announced one thing, then came back saying, actually, no, we're gonna put a pause on this. It's that uncertainty which creates volatility. And not only does the uncertainty cause, for the businesses and what they do, but for the Fed and their actions, they don't know how to respond yet either. So it's
Right.
this policy fog that we haven't really felt in a long time that we don't want to say it's going to be done by X because it truly
Is
we
an
don't
unknown.
have a good sense of that. That
Yeah.
being said, though, I mean, it's at the end of the day, the US the stock market, it's always going up over time, and it just pays to stay invested. But more importantly, now it really points to how being diversified is truly important.
Yeah. And I think one of the big questions we've received kind of over time, and especially in the last week, is, we talk about long-term investing. If you have 10, 15 plus years, you weather the storm, you keep your emotions out of investing. Panic never helps anybody. But if you have 2 to 5 years till retirement, it feels different. And I think really one of the biggest piece of advice that we give. And again, this is where we can come in and help you with those one-on-one meetings also. But you want to look at your overall allocation. And you have to remember that if you're 2 to 5 years of retirement, you'd want to make sure you do have a portion of your account in those safer investments that will be available to you when you start needing some of that money. So 2 to 5 years of income starting to build up in that cash, money market, stable value bonds. Or and then this is a time to, if you're getting closer to retirement, where you want to definitely, when things settle down, maybe look and assess your portfolio, and we can help with that as well. But remember, I think Marta and I were talking about at the beginning, that even your retirement date isn't the date you're taking all your money out of the market. And so you still have a longevity beyond that retirement date also as well. And yesterday was just a good indicator on, if we go back and look at some of the slides we did in COVID, was, some of the worst days some of the best days in the market were within 2 to 3 days of the worst days. That sentiment. So it really is a case in point of looking at your allocation, but not panicking. And we joke in the office, like Marta said in the beginning, is we're not looking at our own accounts. We know that we are invested to our risk tolerance, time horizon, and this is money we're not touching for a long time. And so those were kind of the most common questions that I think, received from most people. Otherwise, if you want to click ahead, I just want to let everybody know too, we are recording this, and the recording will go out to everybody as well. And on you all hopefully have our contact, but on the last slide will be our contact. This is part of our participant webinar series. So we do have some really good upcoming participant webinars as well. The May date is a really great presentation. It's 8,000 days of retirement. It's really well done. And then we always host our Social Security event webinar every July, and then followed by our Medicare webinar in August, probably two of our more popular webinars as well. And with that, I think that really answers the majority of the questions. So I'm really, really appreciative, Marta, for joining us today, and everybody else joining us. We understand that this is a very stressful time, and the amount of volatility is really hard. And just know that we're here to help you. And if you can take those emotions out of your investing, and remember that your dollar cost averaging and making drastic changes is really most of the time going to hurt you in the long run. So staying that course is key. So with that, I think we did really well. We covered a lot in the 34 minutes. So thank you all for joining, and
Thank
let
you.
us know if you need anything. All right, thanks. Bye, Marta.
Bye.